The year is 2019. Walk into any WeWork location in Manhattan, London, or Shanghai, and you feel it immediately, the particular energy of a place that believes it is changing the world. The exposed brick, the craft beer on tap, the motivational slogans stenciled directly onto glass. Founders hunched over laptops beside freelancers, beside the satellite offices of Fortune 500 companies. The company's valuation has just been pegged at $47 billion, making it the most valuable startup in the United States. Its founder rings the opening bell in his mind every morning. The money is real. The offices are full. The future has never seemed closer. Then the silence. By November 2023, WeWork files for Chapter 11 bankruptcy. Not a pivot, not a restructuring dressed up in optimistic language. Bankruptcy. The $47 billion is gone. The founder walked away years earlier with hundreds of millions in his pocket. The employees, tens of thousands of them, are left holding the question nobody thought to ask when the beer was still cold and the walls were still warm. How does a company worth nearly $50 billion simply cease to exist? The story begins, as so many do, with a genuine problem and a genuinely good idea. Adam Neumann and Miguel McKelvey founded WeWork in New York City in 2010. The premise was elegant. Commercial real estate in major cities was prohibitively expensive for small businesses, freelancers, and early-stage startups. The traditional office lease, multi-year, inflexible, requiring enormous capital, locked out exactly the kind of nimble, ambitious operators who were reshaping the economy. WeWork would sign long-term leases on large commercial spaces, subdivide them, and rent them out on flexible, short-term terms. The arbitrage was real. The demand was real. In its early years, WeWork was a legitimate business solving a legitimate problem. Members paid monthly fees for desks, private offices, and shared amenities. The culture Neumann cultivated, communal, energetic, deliberately counter-corporate, attracted exactly the demographic the post-2008 economy was producing in abundance. People who wanted to work differently, who didn't trust the old institutions, who were building something and needed a room in which to build it. By 2014, WeWork was operating in a dozen cities. By 2017, SoftBank had invested over $4 billion, and the company's valuation had climbed to $20 billion. Journalists wrote profiles about Neumann's charisma. Employees described drinking the Kool-Aid and meaning it as a compliment. The company became, briefly, a genuine symbol of how the new economy reimagined not just work, but community, purpose, and belonging. Its pitch deck didn't describe a real estate company. It described a consciousness. That rebranding, from real estate company to technology-driven community platform, was not merely marketing. It was the mechanism of the entire financial architecture, and it was, ultimately, the source of everything that followed. There is a category of corporate decision that looks reasonable from inside a room and catastrophic from outside it. WeWork's defining error was not a single moment of recklessness. It was a philosophy, expressed consistently over years, that the normal rules of financial accountability did not apply to a company operating at this altitude. The specific arrangements that would come to define Neumann's tenure were extraordinary by any conventional measure. He purchased buildings personally, then leased them back to WeWork, a structure in which the CEO stood on both sides of the transaction, collecting rent from the company he ran. He charged WeWork $5.9 million for the rights to the word "we," a trademark he held personally, before the payment was clawed back after public scrutiny. He borrowed hundreds of millions of dollars against his WeWork equity and used the proceeds, in part, to fund a personal lifestyle that included private jets and real estate holdings on multiple continents. Inside WeWork's culture, these arrangements were not experienced as scandals. They were experienced as the natural expression of a founder's commitment and vision. Neumann was not just a CEO. He was, in the company's own internal language, a visionary, a prophet, a man whose interests were so completely aligned with WeWork's mission that normal governance guardrails were beside the point. Board members who might have intervened were, in several cases, simultaneously WeWork investors with strong incentives to protect the valuation. SoftBank's Masayoshi Son had publicly described Neumann as a once-in-a-generation entrepreneur. The checks and balances that might have caught these arrangements earlier were structurally absent, not by accident, but because the culture had been deliberately built to make them seem unnecessary. Meanwhile, the underlying economics of the business demanded scrutiny that it was not receiving. WeWork was signing long-term leases, obligations measured in decades, and renting desks on month-to-month terms. The company was, at its core, borrowing long and lending short in a market that could turn. It was burning through approximately $2 billion per year. Its losses were not declining as it scaled, they were growing. The standard technology startup model, lose money early, capture market share, achieve profitability at scale, was being applied to a business whose unit economics did not improve with scale because the underlying costs were physical square footage, not software. The bet implicit in every pitch and every valuation was that growth would eventually outpace cost, that WeWork would become so dominant, its brand so powerful, its network so essential, that pricing power and margin improvement would follow inevitably. Reasonable people, looking at the growth curve in 2018, believed this was possible. The numbers were moving in only one direction. The IPO was the moment the architecture was required to bear weight it could not support. In August 2019, WeWork filed its S-1 prospectus with the Securities and Exchange Commission. What followed was not a typical pre-IPO skepticism cycle. It was a systematic dismantling by financial analysts, journalists, and institutional investors of almost every claim the company had made about its own nature. The S-1 revealed the full scope of Newman's related party transactions. It revealed that WeWork had invented a metric, community-adjusted EBITDA, that excluded most of the company's actual costs in order to present the appearance of profitability. It revealed that the company's losses had grown from $900 million in 2017 to $1.9 billion in 2018. It revealed a governance structure in which Newman held shares with 10 times the voting power of ordinary shareholders, effectively making the company ungovernable by anyone but him. Public investors, unlike private ones, could not be managed with charisma and a compelling vision deck. They required audited financials and fiduciary accountability. When they applied those standards to WeWork's numbers, what they found was not a technology company temporarily investing ahead of profitability. What they found was a real estate company with negative gross margins on significant portions of its portfolio, funded by a capital structure that required continuous external investment to survive. The IPO was postponed in September 2019. The valuation, which had stood at $47 billion in January, was revised to somewhere between $10 billion and $15 billion within weeks, and then lower still. Newman resigned under pressure from the board in late September. SoftBank, in a maneuver that protected its own position, engineered a rescue package that included a $1.7 billion payout to Newman himself in exchange for his departure. WeWork survived the immediate crisis, but it survived as a fundamentally different entity, smaller, diminished, stripped of the narrative that had sustained its valuation. The company laid off approximately 2,400 employees in November 2019, then more in 2020 as the pandemic emptied offices globally. The flexible workspace model, WeWork's core proposition, was built on the assumption that people would consistently prefer working in shared offices. When a global health crisis made that assumption temporarily impossible and then permanently complicated, the company had no margin for error, no reserves, and no ability to renegotiate the long-term leases that constituted its primary obligations. Between 2020 and 2023, WeWork attempted multiple restructurings. It went public through a SPAC merger in 2021 at a valuation of approximately $9 billion, still extraordinary for a company losing money at its scale and still a remarkable distance from its peak. The stock declined steadily. Revenue recovered partially as offices reopened, but the fundamental problem, the gap between long-term lease obligations and short-term rental income, compounded by debt service on billions in obligations, did not. By mid-2023, WeWork's auditors had issued a going concern warning. By November, the filing was made. The human dimensions of the collapse were not captured in any single headline. They lived in the inboxes of employees who had joined WeWork believing in its mission, who had taken below-market salaries in exchange for equity that proved worthless, who had built careers around a company whose internal culture had insulated it from the feedback that might have changed its course. Thousands of small businesses and freelancers who had structured their operations around WeWork locations scrambled to find alternatives. Landlords in dozens of cities faced sudden vacancies in premium commercial space. The financial losses were real, the disruption was diffuse and lasting. The lesson that WeWork's story actually teaches is not about hubris or excess, though both were present. It is about the specific cognitive failure that occurs when an organization's internal reality becomes systematically disconnected from external accountability. WeWork did not fail because it had bad people or a bad idea. It failed because it built a culture and a governance structure that made honest assessment of its own condition nearly impossible. The mechanisms that exist in most organizations to surface uncomfortable truths, skeptical board members, independent auditors with real authority, an investor base that demands transparency, a press that has access to internal operations, were either absent from WeWork's structure or were neutralized by the company's extraordinary ability to attract capital and manage perception. The trap WeWork fell into is not unique to startups or to technology companies. It is the trap of narrative capture, the moment an organization's story about itself becomes more powerful than the data about itself. When the story is strong enough, when investors, employees, customers, and journalists are all invested in the same version of events, the normal corrective mechanisms of markets and accountability slow down or stop entirely. The organization begins to optimize for maintaining the story rather than improving the underlying business. This is the pattern worth carrying out of this documentary, not the private jets or the trademark purchase or the kombucha on tap. Those were symptoms. The disease was the systematic elimination of the institutional capacity for honest self-assessment, executed gradually and, in many cases, with the best of intentions. Every organization that has experienced a period of extraordinary success carries some version of this risk. The culture that enables rapid growth, high confidence, strong internal narrative, suspicion of external criticism is precisely the culture that makes self-correction most difficult. WeWork did not invent this problem. It simply illustrated it at a scale that left no ambiguity. WeWork still exists, technically. The brand survived the bankruptcy filing, acquired by a real estate investment entity that saw value in the name and the remaining membership base. Some locations remain open. Some former members still work in spaces that carry the WeWork logo. But the company that was valued at $47 billion is not among them. What remains is a name attached to a much smaller, quieter, entirely ordinary business, a company that rents flexible office space and does not claim to be changing the world. There is something clarifying in that outcome. WeWork's rise was built on the proposition that a real estate business, reimagined with sufficient ambition and sufficiently compelling language, could be worth as much as the most valuable companies in human history. Its fall demonstrated, at enormous cost to thousands of people, that the language of transformation and the reality of financial sustainability are not the same thing, and that in the long run, only one of them counts.